Okay, let's go. So first off, um, disclaimer: this is for educational purposes only, not recommendations or investment advice. Please consult your professionals for that, right? Your investment advisor for that. Okay, for those of you attending, thank you for being with us today. Let's begin. If possible, please switch on your video so that it doesn't feel like I'm talking to myself or Nick only. Hey, hi, Michael. Hi. Thanks for showing us your real self. Okay, so this is meant to be this is a members call, right? It's meant to be a casual sharing among our community members. Hope that you guys understand that there's many people of varying skill levels. I have to assume that you've listened to my previous webinar about options and read up on some of the things that we've forwarded to you. So it assumes some knowledge about puts and calls and some rudimentary knowledge about options, right? But to begin, I will just go briefly touch on options. The way I look at it beyond the textbooks, I know there's a lot of definitions of options, and then we'll move on to the various scenarios that we use options, explain more of those times that we actually use options. As I said in the previous webinar, we don't do the income investing kind of things, right? Which is basically trying to pick up pennies in front of a bulldozer, right? So then Nick will go on to talk about the 3 option trades that we're currently looking to do or have already done some. In any case, let's begin, and then you can have questions, Q&A later, right? Feel free to jump in at any point if it's confusing. I think it's going to be that way because not intentionally be that way, but it may confuse some of you. But you just have to take some time to digest. There was interestingly, we had very good feedback from most of the members of the previous audience in the previous webinar. But one person who said that he was very well versed in options, he was confused by my explanation about options. And I guess it would be that way because it is not so textbook-ish, right? It's not about the theory and stuff like that. It's more about practical use of options, and it's approximations to the truth, but it's good enough for trading, right? If you're not a market maker in options, right, you just use it to supplement as a tool, as a supplement to your overall portfolio. So briefly, the option prices depends on strikes. The strike price is quite intuitive. The strike price is the contract price which you agree with the counterparty on whether you can buy or sell the stock, right, depending on call or put. And the current market price and time to maturity, implied volatility, and the level of interest rates. And of this, the most important of course, is the difference between strike and the current market price. And actually, it is not really the current spot market price that is used in the option prices, right? Option pricing, it is the forward market price or future market price, because we are talking about time to maturity. So if it's a 3-month time to maturity, we are looking at the forward pricing. And that's why there's level of interest rates involved. With level of interest rates, you can use the current market price, you can imply the forward market pricing. So for all intents and purposes, in the zero rate environment, if you are trading stocks, the dividend is quite low. The forward market prices are very similar to the current market price. So for all intents and purposes, it can be approximately what you just need to use. And I tend to speak of spot price because it's, it becomes a bit more confusion for people to talk about forward pricings and stuff like that. But I hope there is no confusion on forward pricing. The theory is that it uses forward pricing, and when that becomes very noticeable if you're trading in currencies where the interest rates, the funding currencies, the funding rates of the currency, the interest rates of this, say currencies, say for example, Turkish lira or Brazilian real, they are very, very high. So the forward pricings is quite significantly different from the current spot prices. So you have to be careful of that, right? And of course, what's important is also time to maturity. And in fact, option traders, okay, this is a professional option traders where they have a portfolio of options. It's not casual traders or retail traders who, you know, buy and sell options based on just their portfolios, but these are market makers. They actually trade implied volatility. Implied volatility is not historical volatility. Historical is the past, implied is what they think the future is, right? So when they show you the option pricing, their view, they're expressing the view of level of volatility going forward. So this is a textbook, right? You just need to have a little bit of understanding so that you know what's going on. It's oh, okay. Mansfield video was a bit confusing for me, right? He's showing me his t-shirt just now. I was like, what happened to his face? And anyway, let's move on. Price of options has two components. Okay, so time value. The textbook definition is this long sentence, whatever, right? But it essentially measures the value of the option according to the amount of time remaining until the expiration of the option. Okay, then the other part of the value is intrinsic value. It is derived from the difference between the price of the option, the strike price of the option, and the current price of the underlying. Of course, again, it depends on whether it's call or put, right? If there's intrinsic value or not. But regardless of whether it's a call or a put, the time value for the same strike, for each option, for the same strike, for the same maturity, the time value is the same. Okay, so this is a very important concept, and it will help you in understanding how you should trade options in that when it becomes deep in the money, you know, then it allows you to really measure what is the value of the option beyond what the intrinsic value is. Okay, because you can I think diagrammatically is probably easier, right? So this is the on the left scale is the strike price, and the spot price is current. Of course, as I said, this is approximation because it's forward pricing, right? But the time value of the option is the same whether it's a call or put for the same maturity and same strike. Okay, so it's same maturity and same strike. So if, for example, your strike price is 100, the spot price is 200, right? There is an intrinsic value for the call option, right? Because the market is higher than where you can buy it using your option, then there's the intrinsic value. But for the put option, you are selling below the market. There's no reason to exercise your option, right? So there's no intrinsic value. So negative intrinsic values are not, it's just zero, right? It's maxed out, minimum is at zero. So if you can see it this way, then you understand the concept of put call parity, which I will go through in a little bit. But let's go through simply with an example, right? For example, for this stock ABC, the current price, market price is 200, and then if the call option has a strike with a strike price of 100 is worth 101, right? What is the time value and what is the intrinsic value? Okay. Of course, you can later go through it, you know, think through, but I'll just walk through the thing, right? Intrinsic value is, as I said, the option strike minus the market price, right? Or the other way around, right? If it's a call option. So it's 200 minus 100. So it's actually market price minus the strike price, right? It's if this is for, if it's put option, right? But this call option, so it's 100. And then the time value is basically the price of the option, which is 101 minus the intrinsic value. Okay, is $1, right? So because we are we are not having inputs of volatility and everything into is you can find the time value by two ways, right? You can put in the assumptions of volatility and everything into a pricing model, but I assume that none of you at home has a pricing model. So you can just use observable inputs from the market to imply the time value. So you basically just see what the option price is in the market, and then you take away the intrinsic value, and then you will have the time value. And what this means is that the option outside of the intrinsic value is worth, the time value is the optionality is worth $1, right? So if to answer the price, what is the price of a 1 month put with a strike 100? If you recall, time value is the same for the same strike and the same maturity, right? So it is $1, but if you use the diagram, it is quite easy to see, right? That the intrinsic value is 100, the time value is 1, and for the put option, the time value is 1. Hence, the price of the put option is also 1, right? So this concept, I'm boring you this concept because it's quite useful in assessing what you should do with a dip in the money option. Okay, so for example, you have a very deep in the money means you're making money. Okay, so out of the money means, yes, as it implies, you're out of the money. It's way the market is way very far from your strike price of your call option. It may mean that it's very much lower than your call strike price. There's no need to exercise, so it's out of the money. But in the money means the market is much higher than your call strike price, so it makes sense for you to exercise at maturity. But that is the intrinsic value, right? The difference between the current market price of 200 and your strike price 100 is that intrinsic value. So many people will think that because their option is $101, and then they say, oh yeah, no, I want to lock in the profits, I'm just going to sell out this option. But a better way to do it, a better way to do it, if of course allowing you, it depends on your brokers and your depends on your broker platform and your access to options, right? If and the margining, the margining, okay. So for example, if you look at payout profiles, okay, when you're long a call, right, you don't lose any money below the strike price, because let's just say you paid for the option already, right? We don't include the option cost into this, but you start to make money at okay, we have a mistake here. Actually, the cross of these two should be at a 200, not 150, at 200. Okay, we sell the stock at 200. Okay, so Yirong, just make sure we change this slide later, huh? I didn't notice this. So in any case, you can, instead of selling the option, the call option, you can sell the stock. Okay, whatever this option allows you to buy 1,000 stocks at 1,000 shares at 100. You can sell 1,000 shares at 200, which is the current market price, and your payout profile will become something like this, where you have locked in the 100 profit, and then you'll start to make money if the market collapses below 100, right? Because that is the payout that you're getting from being short the stock. So essentially, your payout profile looks on the orange line, right? Essentially, your long call short stocks becomes a long put option, and that is the case. That is what because you have locked in the intrinsic value. So if we go to the chart where okay, before we go to this, we go to this stock, right? Because you have locked in the intrinsic value by selling your stocks, you have turned your position into a long put option. Okay, so this is important because we are using stocks as a supplement to, quite often, as a supplement to our underlying portfolio. So let's just say, for example, we are long long this stock, right? ABC stock, and then we also bought a call as a as a as a as a supplement to the underlying. It's likely when we have a macro theme, we have both the stocks which have started to do well, then we start to buy very low delta options, which is very far away out of the money options on the upside. And let's just say it's gone in our favor, as the case for maybe for some of the stocks that we have, like Anterior Resources and all, is like triple from where we started to get in. So we have options that are very deep in the money. Then a lot of people, when they look at their portfolio, they'll be like, oh, my options is so much, I don't want to lose money on my options now that it's so much. But what we'll do is we don't actually sell out the options unless the price of the thing, the price of the time value is very high, right? We believe that there's no reason to have some optionality. But if the case where we always check, right, is the case where it's $1, yes, maybe we would like to have that $1 locked in as well, so we sell the option. But let's just say it's only, the time value is only like 10 cents, right? 10 cents. Why bother with if you can keep that optionality? So we tend to sell our underlying stocks away rather than our deep in the money calls away. Okay, so this is one concept that I stress that you guys should try to understand. For some of you who are very familiar with options, it's very intuitive for you. But for some of you who are just starting to use options, you will tend to. I've seen many traders who are professional traders as well, but when they're very new to options, they get very nervous when the market has moved very far away from their strike price. They're making a lot of money. They keep thinking that they need to get rid of an option because they don't want to lose their profits. But it's the same thing as being long the stock at that point. And actually the time value, the optionality cost, the cost of that optionality is very, very low. And you really shouldn't sell it, because when you sell it, you also cross the bid offer spread of the market makers. And there's no point, right, if you can keep optionality in your portfolio at very cheap cost. Okay, so this is a very important concept. It's in books they call it put call parity, but it basically means that you can replicate, you can use the underlying shares contract or FX pair or whatever. You can use the underlying to replicate with a call or put some. So with the call and the underlying, you sell the underlying, you can become long the put. If you have a long the put, you have the underlying, you buy the underlying, you can become long or call, right? So using these three things, the call, the puts, and the underlying, you can replicate the payout structure of either one of them. So this is very important in that always when you sell option, understand that what you're selling, right? So there are some income strategies which I guess it encourages people to sell in the money options, right? Because it seems like, oh, you're locking in a lot of premiums, you're taking in a lot of premiums, you're collecting a lot of income. But what they're doing, they're selling intrinsic value, which is basically kind of like it's just gaming the people who don't really understand what they're doing. So you understand that options have two components to their prices. One is the intrinsic value, and one is the time value, right? The time value needs to be assessed separately from the intrinsic value, so that you know what kind of price you're paying or receiving for having the option or selling the option. Okay, cool. So beyond put call parity, we talk about the option Greeks. The textbook definition is is the degree the price of the option changes according to the changes in the price of the underlying whatever, all these things, right? But intuitively, the delta is the probability of the option ending in the money, right? It doesn't measure how much in the money, but it's just saying it's in the money, right? So that's why for when the strike of the option is the same as the market forward pricing, so spot plus interest rate differentials, the delta of the option is 50 because the market, when the strike equals to current market price, there's a 50-50 proposition as to whether it's ending in the money or not in the money. Okay, so when we are buying low delta options, we are looking at strikes that are like 10 to 15 to 20 delta. The market is telling us that the probability of the market rising above these strike prices is only 10%, 15%, right? And that's and we look at it this way, right? We it's so instead of you forget about option theory, you just trade it intuitively like we do, is that when we look at the macro proposition, we look at our macro themes, right? So we are saying that there's a disconnect between where the market is pricing these outcomes and where we think the outcomes of the future is, the likely future outcomes, right? So at a 10 delta option, for example, a 10 delta option, the market is saying that there's only a 10% probability of the market rising above this price. So for example, if the stock price now is 100, and let's just say the market prices the 10 delta option strike is at 250, okay? So the market is saying that given current scenario of volatility and where the market is, so let's just say it's a 1-year option, they say within 1 year, there's only a 10% chance of the market rising above 250. Okay, so then because of our underlying themes, we are looking, okay, so actually the market is mispricing, right? This 10% probability is too low because given what we think is going to happen to the market, to the world, we think the outcomes are very skewed to the upside, right? We think actually it's supposed to be 20, 30, 40%, right? And then that's why we are saying, okay, then this option to us is mispriced, right? Because it's just a 10% probability that they're assigning to this outcome, right? So of course, as the market moves towards that strike, or as volatility rises, as market views change, right? Maybe there's news like for example, there's major central bank meetings, or there's conferences where governments are going to agree to new ESG rules or whatever, right? That will change the probability of the market pricing, right? The delta might change according to things like that. So this is how we view option intuitively, right? We don't really have a view on volatility. We are not volatility traders. We don't really have a view on all the other deltas, all the other Greeks, right? We are just saying that, okay, this probability, according to the world and according to our framework of risk and according to our macro themes, this probability is too low. Hence, it's too cheap. Also, we are buying all these low delta options. So that's why when people ask us why are we always looking at low delta options, this is the reason why, because we think the assigned probabilities, the market assigns very low probabilities, and that's why we have most of our trades anyway. Because if you look at our model portfolio, the targets for the stocks are just way beyond the normal outcomes of like 5-10%, right? We are looking at 50%, 100%, 200% outcomes, right? That is the structure of our portfolio, right? Okay, so then theta, right? It basically measures the loss of value of the option with passage of time, because as we said, a big component of the option pricing, the price is time value, right? And time value changes. Let's just say everything remains the same, the market doesn't move, right? Let's just say volatility assumptions remain the same. Tomorrow comes, then the option price it drops because 1 day less of the option, right? Given all the same assumptions, but 1 day less of the option, then the time value is eroded, it decays. So that is the time value of the option that's being decayed, right? So it's the decay of the time value, and it quantifies the loss or gain to your portfolio while one day passes, right? So that all the income strategies that we're talking about, they are looking to have positive theta, right? Positive theta, positive time decay, right? So they want to make money over the weekends. They want to make money when nothing happens, right? So yes, in general, that's a great way, right? It's just like the guy who sell insurance. Nothing happens. The weekend comes, nothing happens. You feel very good about yourself. You collect a bit of money, but eventually something bad happens, then you get crushed, right? So we monitor this in case we have this is only useful, not useful. This is only relevant to our portfolio when all the low delta options that we have become the market has moved very close to the strike prices. Then there's no intrinsic value yet because it's not above the, or it's very low intrinsic value. The strike price is very close to the markets, but the bulk of the option value is in the time value, and then it becomes significant because every day that passes, one day less of the option portfolio, then the time decay is expensive, right? So it's something that we monitor when we have a lot of options, or as we have options that are very close to expiry, and the market is very close to the strike. And then in those times, we will likely, sell out the options if we think there's not going to be much volatility, the option is not going to move a lot. So again, we compare the intrinsic value, we extract the intrinsic value from the options and see how much time value is left, how much we want to extract, how much we want to pay the time decay, right? So yeah, so basically, that's how we use the Greeks, right? That's just a few things intuitively. Of course, we can talk about many dimensions of risk: gamma, theta, vega, rho, and then there's actually if you trade a lot of options, there's the change of vega, so they call it VOMA. There's a lot of things, right? But don't be confused by all these things. All these things are only relevant for higher order traders, of not higher order in their better quality, but they're trading more orders of the option pricing, right? For us, as the retail stock trader with a macro theme underlying all the trades that we have, we only really need to look at these few things. Okay. Rule of thumb in various scenarios. Nick, you want to talk about this? Hey, Nick, are you there? Hello. Nick, where did he go? Hero, maybe you check Nick's system is working or not. He's gone off for a second, but in the meantime, let me just continue. Okay, so there are a few scenarios where we use options to trade our themes, right? One is macro theme investing. That means we have an underlying macro theme. If you look at our model portfolio, there's quite a number of themes which we are invested in. We tend to first buy the underlying, right? We just get involved in the underlying, and then as it starts to perform, more things confirm our view, then we supplement it with low delta options, another scenario is a distressed asset. So maybe something that's gotten out of favor because of news, because of change in environment. One of it was one of it that we have is the energy theme. For at first, like a few months ago, it's almost a year now. Yeah, it's the uranium complex, right? Everybody thinks uranium is bad because nuclear is dangerous, because of Fukushima, Japan meltdown, right? People start to think, it's very dangerous. But of course, time has passed, and technology has gotten better in controlling all this fallout, right? And preventing meltdowns. And they were very distressed. So one thing, and currently the other thing that's very distressed, in our opinion, is like energy complex, oil assets, coal assets and things like that. So distressed asset investing, of course, there's overlap, right? Like, oh, do we really need to know if it's macro theme or distressed asset? No, there's an overlap, right? There's quite often our underlying macro theme sometimes has distressed asset components in it. That's why it's mispriced, right? Special situations, not so often because that's why it's special. If it's not special, then it's often, right? If it's very often, then it's not so special anymore. Special situations would be times like maybe the meme stocks, GameStop, or a central bank meeting, or something that we maybe Brexit, something like that, right? So all these outcomes, all these maybe news events or central bank meetings or regulations or market conditions, which is GameStop. There's nothing. It's just market conditions. Like this, hedge funds were all short too much of the same stock, right? So these situations allow for extreme mispricing. Not extreme mispricing. It allows for extreme moves that are very unexpected, right? Again, it falls back to the same thing, the intuitive definition of delta for us, right? The probability is mispriced for us, right? In each of these situations. Okay, Nick, you're here. Come, you want to talk about the rules?
Yeah. Okay. So for macro theme investing, we typically, so in general for model portfolio, we tend to do options that are not too short now. So typically from 8 months minimally to up to 2 years, right? We do have some option trades which are up to 2023 expiration. So that is mostly for our energy and uranium trades, right? It is mostly about 2 years out. Yeah. So we tend to want to do strikes between 15 to 25 deltas. That is because I think we mentioned in our previous webinar, options webinar, that is the fastest rate of change for the deltas, right? And we want the best bang for the buck. So, and most of our macro themes, we expect assets to trend way beyond their current price, right? And that is why we tend to go much further out of the money than just 1 strike to 2 strike out of the money, right? So we tend to go for those deltas. And because for macro themes, we have higher conviction, we risk about 2 to 4% of our count for each trade. That is excluding the underlying, right? That is just purely invested in the option contracts. So that is where we tend to go for it for. Right. For distressed asset investing, our option contracts tend to be more than 1 year because it's hard to figure out when it's going to turn around, right? You don't want to get options which only last for a few months and then you need to be very accurate on your timing. So most of the time, we tend to go in when we feel that the asset is coming around, when it's turning around. So we think that typically 1 year time frame is very comfortable for us, right? So that we don't need to be too accurate on that. So one of the distressed asset plays that did extremely well for us since last year was Antero Resources. We got in at almost the bottom of the natural gas sentiment, right? When everything was very depressed during the COVID time, and Antero Resources, I think, more than tripled for us. So that is one of our distressed asset investments and options for 2020 into this year. So the strikes we tend to go for distressed assets is about 10 to 20 deltas because, and the reason why it's further out is because when these things turn around, it tends to be much more explosive than your macro theme investing, right? Which you think the uptrend to be more linear and less volatile. So that's why you want to go further out, right? So we can get more exposure and a higher rate of return when things go our way. So for this, we tend to risk 1 to 2% of the account. It's more risky, more speculative, and hence the risk exposure is slightly lower. And also this is excluding your physical underlying of the stock, right? So for distressed asset investing, we tend to just do the options first, right? And then if things start to turn around, then we will scale in into the physical stock. That is different for macro themes. So macro themes, we tend to buy the stock first, and then do the options overlay, right? For distress, we tend to do the options first, and then the physical stock if it starts moving our way. And then special situations bet. So this varies, right? From 1 week to 1 month. So this is things like GameStop and stuff like that, right? Where we want to speculate on a shorter time frame. So for special situations, we tend to go 10 to 30 delta. So it's a wide range because if it's 1 week to expiration, then we don't want to go too far out because it's the probability is a lot less to expire in the money. So we tend to do within this range, right? And because it's very speculative, we tend to do 1 to 2% of the account, and we typically don't buy the underlying stock, right? Because we either most of the time let this expire worthless or expires deep in the money. And I think we did a call, right? You did a call on GameStop, right? Which did extremely well, right? Before
AMC.
Yeah, AMC. Yeah. Yeah. So special situations bet. So this is the time frame that we look at. So to go through some of the options trades that we are looking at the moment, some of them of which we are still getting filled. So the first one is Transocean as a distressed asset in the oil industry. So Transocean, why we like it is, okay, the second one is Occidental Petroleum. So that's for a macro theme with regards to energy and oil as well. And the last one is Wheaton Precious Metals, and that is also a macro theme options trade, right? So these basically are the three option trades that we are looking at to put on. So for Transocean, we are in the process of getting filled. Wheaton as well in the process, and Occidental we just put it on, which we will update in the Slack later on. So for Transocean, why we like it is because it is one of the last ultra deep water drill ships standing. So it's like I don't know if you guys got watched Forrest Gump, right? When the storm came, all the shrimping ships got destroyed, and they were the last guy standing, right? And they made a ridiculous amount of money because they were the last shrimping ship, right? So it is pretty much similar for Transocean, right? They are one of the last operators. Of course, they have other competitors like Noble or Valaris, but most of their drill ships are in cold stack, which means that it is very, very expensive and costly to bring them out to again, right? So they are one of the only ones that they can be contracted. And why we are interested in ultra deep water again is because as shale oil drilling is not as cost efficient as in the past in the US, because most of the easy oil has already been accessed, and now if you want to do shale oil drilling, is actually more expensive than ultra deep water oil drilling, right? And that and that's the reason why we are looking at it, because ultra deep water also makes a lot more. V, you moving the thing up? Yeah. And also because ultra deep water makes a lot more sense because it is a lot longer lasting, right? And the amount of oil production that comes out is a lot more sustainable, right? And that's what we believe, that big oil companies will start to explore again, and we believe that Transocean will make a record amount of profits, I think towards 2022, right, when they get a lot of contracts as oil prices increase. Yeah, so break evens are lower, and there's going to be a supply deficit in energy, which we think is going to force ultra deep water exploration again. So for Transocean, the trade that we're initiating is the 561 days to expiration trade. So it's on the left-hand side here. So for all these, we'll put the details in Slack after this. It's a January 2023 expiration contract, which is actually the longest contract that we can find in the option chain for Transocean. And we are buying the $7 strike rate, which is here, for a price of about 120. So that was our fill price for some of our contracts yesterday night, right? 120. So that is the trade that we're putting on. So for illustration purpose, we'll assume $100,000 account as we walk through the scenario, right? So our target price for Transocean is about $40. As we go into 2022, I think it's possible that we hit $40 before 2023. And historically, $40 is not a very high price for Transocean when it was trading well into its hundreds in the early around 2000s, up to 2010. Right. So that is our target price. So there's a lot of room to run. So basically, assuming a $100,000 account, we are risking about 2% of our account, right? And basically, if it hits $40, we will return multiple folds now on our option trade, right? So we are looking for a fuel price of 120 for Transocean, right? And the other one that we're looking at is Occidental Petroleum. So what's interesting is we think that the bull market in energy has yet to begun because most of the futures contracts, they are not moving as much as the spot price. So for energy, it is not as forward looking as markets. So it is mostly a demand is here now kind of product, right? Where they price in extremely near-term or short-term supply shocks. So what you're seeing in the spot price on the left-hand side, which is the blue line, is it is trading at quite a large premium relative to the back-month futures, right? So most energy companies, their revenue is very dependent on the futures or back-month futures, right? Because that is where a lot of their supplies are being contracted, and it's not being contracted at the front month, but back-month prices. And that means that the supply deficit that we have been talking about has not really been registered by the back-month futures, right? So we think that eventually it's going to register in the back-month futures, and that's where we think that a lot of oil companies is going to do very well. And Occidental Petroleum is a very leveraged play on oil because they have unhedged books, and they have a very huge short, rather quite a large short float, right? So we think that Occidental Petroleum is going to do well. It was depressed for a while because Carl Icahn was selling a sizable stake in his Occidental Petroleum holding, but I think that selling has been done. It's almost done. Actually, I think he's liquidated his positions. And we think that Occidental Petroleum has a lot of upside as the back-month contracts start to price in the supply deficit, especially with all this ESG stuff and all. Financing for exploration is staffed, and now that it appears that OPEC is in control of the oil situation for the first time in a long time, they're not going to they're going to take this chance to maintain oil prices, right? They're not going to go crazy to start producing a lot. And with Iran's new ruler, who is not very friendly in terms of uranium and nuclear agreement, we don't think that Iranian oil production is going to be a huge risk to the supply, right? To the supply story. So we like Occidental, and we think that it's going to go a lot higher from where it is. So for Occidental, for the same thing, we are going for the furthest contract that we can find in the option chain, which is 161 days to expiration, January 2023, because we think most of the supply story is going to emerge in the late half of 2021. And the first few quarters or the first 2 quarters of 2022, right? So 2023 is extremely it's the most comfortable date that we can find currently available in the option chain, right? So we are going for the 47 strike call because we think that Transocean is going to go much higher than that. And our average fuel price is about 280. We're still getting filled, so our update in the Slack after this. Right, so our target price is $80. Transocean is about $29 now. So our strike price is 1/3 the way there. So it's comfortable relative to our price target. And of course, based on a $100,000 account as well, we're risking 3%. And so if Transocean hits there, then your profit will be $30,080, which means it's a 1 to 10 risk to reward. If it hits our price target. And the last one is Wheaton Precious Metals. They are a gold and silver streamer. So we think that negative real yields is going to be here to stay for a long time. So it's going to drive out performance in gold. And these assets, although it doesn't seem like it for the past few weeks. So Wheaton Precious Metals is a blue chip streamer. So it is trading at a very attractive valuation right now. And we think that it's going to go much higher when prices recover, right? And we like streamers because it is less volatile as compared to miners. And if you actually look at the relative or the absolute performance of streamers as compared to the physical spot price of gold and silver or miners, streamers have actually outperformed on an absolute basis for a very, very long period of time. And we think that's going to continue, especially in the low rate environment, right? So yeah, so for Wheaton Precious Metals, we are doing a spread instead of an outright call. Now I'll explain how we're doing a spread and then in a bit. So same thing, we are going for the January 2023 expiration, 561 days. We are buying a 60 strike call and selling an 80 strike call, right? So the spread, the debit amount we are putting in the market to get a feel is about $1.75. And the risk, so our target price for Wheaton Precious Metals is $80, right? So it's basically crossing all-time highs, which is seen in about mid 2020, right? The reason, okay, so for the spread amount, again, $100,000, we're risking 3% of the account. So we are outlaying $3,000 for max return of 30,000. So that's a 10:1 profit as well. And the reason why we're doing a spread is because for precious metals, as opposed to the prior to oil plays, we don't think will be as asymmetric, right? So we are comfortable capping our gains at about there because we think that it's going to be harder for Wheaton Precious Metals to be explosive because it is, first of all, it's a blue chip streamer. So we don't think that there is going to be massive repricing in this thing. We think that it's going to be a very steady upward trend into 2023. And it brings down our cost basis quite a bit by doing a spread here. Allows us to get a decent risk to reward of 1 to 10. So basically, how we decide to do a spread or a outright call position is, of course, number one is implied volatility. I mean, if implied volatility is extremely high, then we will prefer to do a spread. And also the asymmetry of returns, right? If the returns are not going, if we expect the returns to be more linear, then we will consider doing a spread, right? But if we think the returns are going to be very asymmetric, like the prior to oil plays and especially Transocean, then we will not do a spread trade to get exposure, right? So it depends on asymmetry and implied volatility in our decision making on whether to do a outright call or a spread. Yeah, so that is the end. That's the three options that we're looking at. I'll put in the details in the Slack after this.
Okay, very good. Thanks, thanks, Nick. So any question, guys? Boys and girls, do you have any question for us? Kin, you look like you have a question. No? Just look that way all the time. All right. Are you sure you don't want to ask questions, right? Are you sure? Okay. Calm down. Hi.
Hi, Elton here.
Hi, Elton. How are you?
I'm good. How are you?
Okay. I'm okay. Come, that's good. Let's cut the small talk.
So the question is, if you are long the stock, but less than the call option that is deep in the money, do you sell off only what you own, or do you actually short the stock?
Okay, very good question. So you can sell the stocks, right? Then after that, you still feel that you have too much intrinsic value to lock in, right?
Yes.
If your platform allows, yes, I think that's what I will do also. I will sell some stock against my option, right? Then because the P&L is locked in, right? If I lose money on the stock short, then I make money on the option rise, right? And basically you're locking in the intrinsic value. Yeah, you can. But I'm not sure, but there are probably some brokers that are not so good at their margining, so then they will still margin you on the stock part, right? Where they don't actually think you are offsetting the risk of your options. If it's that case, then you will tie up some of your margin. Then maybe it's better to just sell out the option, right? But if it's not, then I think still okay. You can just do it. Yeah, correct.
Okay, thank you. Yeah.
No problem. Any other questions?
Yeah, I think there was one question about Cresat, right? Cressy. Yeah, Cressy is one of my from Lionel, I think. Cressy is one of my key holdings. It basically is Argentinian farmland. I think the reason why we didn't do options on Cressy or Cresat is because I think it's not liquid enough, and the bid-ask spread is too wide for us to do that. So unfortunately, we can't do that. So for Cresat, it's just pure stock exposure.
Yeah. Okay. So the availability of options is quite restricted in some of the things that we trade. So it's sometimes, we would like to have lower deltas, but they actually don't. We would like to have longer maturities, they actually don't. There doesn't seem to be any order around how much they have, right, Nick? It seems like
Yeah.
some have more, some has less based on liquidity of the stocks. So I guess that's just it. How about Peabody also have bought stocks? So you have made a lot of money, right, Lionel? A bit harrowing 2 days, right? Up 25%, down 10% last night.
Yeah.
You guys see, so for those of you who have bought Peabody, you must have been very, very happy the day before. Then last night a bit stressed a bit, right? But I don't have. Nick, did we buy options? You don't have, right? PTU?
No.
Oh, no, yeah. Actually, I haven't checked the availability. I think essentially some of it we don't buy the options because I think we have enough exposure. We added quite a lot to our VTU, right, Nick? Actually, Nick added VTU to his personal portfolio like just few days before it exploded, right? I mean, he has our inside information. But okay, yeah, we don't have the options, but feel free to, of course, that's why we have a community, right? Feel free. I think some of you are better, well, not better, some maybe better, but also look at options more often, right? Feel free to explore using the themes that we have and explore the options. And sometimes we don't suggest it. It's just because we are not that familiar. We just haven't had the time to look at it. If you find anything that you think is compelling, please share. There's a channel called Trade Bot Community, right? It's for you guys to suggest your trade and then seek opinions, right? I think a lot of people feel that they don't like to talk to people about their trades because if it goes wrong, then they feel responsible, or they feel that they don't feel so good. But it helps you to have a level of accountability, right? If you are able to talk about your trades and then don't be offended if people disagree with you, right? Because it's great, right? I of course sometimes because I write a lot on social media, not a lot. I write about our thoughts on social media. You won't believe the feedback that I get, right? Some people think I'm an idiot, right? Because I write the same thing all the time. But it shouldn't really affect you because it's a cheaper way to have disagreement from people about your opinions rather than to see the P&L going wrong, right? Which is basically the world telling you that you are wrong, right? So feel free to use that. And some of the stocks we don't have options, not because we don't believe in it. It's just that we haven't gotten around to it, or we have a big enough allocation from our cash component. Yeah. Thanks, Andrew Harris, for your comments. We will try to generate more thoughts on this, and please feel free, as I said, use the community channel to talk about the trades on options that you have looked at, right? Then we can also talk more about it. Okay, is that's it? No more questions? Any more questions?
Nope, don't think so.
All right. So, well, this is not the end of your chance to ask questions, right? You can ask in the Slack channel. And then also, Yi-Rong just put in a survey. Please try to fill in the survey. I know it takes a few minutes from your side, but it helps us improve our membership calls. As always, all your feedback will let us inform us on how to further improve this sharing sessions, right? There will be a recording. Yi-Rong will do it as soon as he can. Please bear with him. Okay, thank you very much. And as always, stay true to the investment process, and eventually you'll be profitable, right? As some of you clearly are from your P-body stocks, right? It's good to have a chance to talk with you guys again. We'll inform you of our next session soon. Thank you. Thanks for taking your Friday afternoon time to spend with us. Take care.
All right,
please
thank
fill in
you.
the survey. Okay, cheers. Bye-bye.